Hey everyone, and thanks for jumping back into the Equityverse. Today, we're going to talk about the S&P 500, and we're just going to be providing a general market outlook. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and also check out Into the Cryptoverse Premium at intothecryptoverse.com. I wanted to just provide some thoughts about the S&P 500. It has been a little while, and of course, we are coming into that time of the year of pre-election years where the market does tend to cool off just a little bit. We talked about this in the last video, and now you can see that it is starting to transpire a little bit. If you're unfamiliar with what I'm talking about, if you look at, say, the year-to-date ROI of the S&P 500 in election years, right? If you look at the election year average, you'll often see that by about day 145 to 150, the market sets a low, okay? Now, currently, we are on day, 114? About 114 or so. And so we're not quite there yet, but we have already seen about a 6% drop. So this is very similar seasonality that we even talked about late last year. If you guys remember, back during the summer of the pre-election year, I suggested that we could get a 5 to 10% correction in the S&P 500 thanks to general seasonality, right? And if you go back and you look at what happened in 2023, you can see that we did get that, that correction. And if you overlay it with pre-election years, on average, right, you can see that the market does tend to cool off in about Q3 of the pre-election year. So we did get that 5 to 10% correction back then. Now, while we did talk about that, I said pretty quickly after Yellen issued shorter duration than the market was expecting, and they essentially kicked the can down the road by a lot of measures, that was basically bullish for the stock market because it was bearish for bonds, right? I mean, I think if she had issued longer duration, that correction could have theoretically continued, but when she issued shorter duration, it was not the best outlook for the bond market. And so the bond market then fell, right? If you overlay the 10-year onto the chart, you can see that the 10-year topped out right there, and then the 10-year came down. All right, so the 10-year yield came down. So what you'll notice is that this correction over here corresponded to the 10-year breaking to the upside. We just saw a 6% correction right here, and you'll notice that it's corresponding to the 10-year yield moving back up to the upside. So as the long end of the yield curve goes up, it puts pressure on risk assets. Now, so far, all we've really seen is a fairly modest correction, right? Now, you may notice back over here in July, the very first pullback was about a 6% pullback to that bull market support band. Very similar pullback right here, right? About a 6% pullback to the 20-week SMA. Following that, though, the S&P then rallied back up about 5%. Now, from where we found this local low, the S&P is already up about 2.2%. So it already has rallied up off that low sum. A 5% rally would actually take it all the way back up to around 5,200. But what you'll notice is that it essentially sort of zigzagged its way down for about 3 months, right? I mean, this really started in July and it ended in late October, right? It started, I guess, mid-July. So you had August, September, and then it bottomed out in late October. It was about a 3-month correction or so that ultimately saw the S&P drop about 11%. So it actually dropped a little bit more than I think what I suggested. I said about a 5 to 10% drop back then. It actually dropped about 11%. And so then, of course, Yellen issuing shorter duration, we saw the S&P climb on all the way back up. And now it is once again started to find a little bit of weakness. But remember, there's oftentimes some seasonal weakness around that April, sort of that March, April, May timeframe in the S&P 500. Again, here is showing this year with the average of prior election years. And on average, we sort of set a low sometime way out over here. And if you compare this year to other years, it might not be that interesting to compare it to 2020 because that was the pandemic year. But if you look at other years like 2016, you can see that it followed a similar script, right? Kind of moving up and then sort of settling back down into May and June. 2012 is almost a carbon copy of what we're seeing right now, where it sort of moves up, gets a pullback, and then gets sort of a bounce into the last couple of weeks of April. It then went on to roll over sort of into that May and June timeframe. The 2012 script here actually looks very similar to what we saw in Q3 of last year, right? You set a low, a lower low, and then one final low, right? Now look at the year-to-date ROI of the S&P 500 in 2012. In this sort of this phase of the election year, you set a low, and then you get that bounce into late April, and then you have a lower low, and then one final lower low before then picking back up for the rest of the year. And so that is something that I think we should be aware of is this sort of repeating this same pattern where you kind of come down, you get a bounce back up, that could go as high as maybe 5,200, and then you go below the bull market support band, and then ultimately try to find whatever your low is going to be. So if it were to reach the same extent of this correction, it would actually put it all the way down at around 4,700, something like that. Again, there's no guarantee that it goes that low, but I did want to at least highlight a couple of things. One of which is this trend line that you could sort of draw out and say that the S&P has been holding as support, with the exception of this fake out right here below the trend line, which also corresponded to sort of capitulating pretty far below the bull market support band. Now, what's really interesting about this is you can overlay sort of HYG minus the VIX onto this chart. And one of the things you'll notice here, actually what I'm going to do is I'm going to do it the other way around. I'm going to pull up that metric, right? So we're going to pull up HYG minus the VIX, and you'll see on the HYG minus the VIX, you can see sort of a series of higher lows that are forming, right? You see those higher lows that have been forming. Now overlay the S&P 500 onto that chart, right? So we're going to, let me switch this over. So let me actually switch this to a log. Now I want this one to be a log. This one can just be a regular scale. And what I'm going to do is we're going to sort of look at this trend, okay? So we're going to say, all right, well, if you connect the dots here, right, this low corresponded to that low on the S&P 500, right? And then this low corresponded to the next low on the S&P 500. Remember, the S&P was also on sort of a similar trend line where this was a fake out below the trend line, but that fake out also tagged this part where HYG minus the VIX tagged that trend line. You can see that HYG minus the VIX just tagged that trend line again, but while it did, it has tagged that trend line, the S&P has still not gone back to that trend line. And for the S&P to go back to that trend line, it would correspond, to a 4,700, 4,800 S&P for it to go back to that trend line. So again, I mean, this is just basic general seasonality. It has nothing to do with underlying macroeconomic conditions or anything like that. It doesn't mean that it doesn't evolve into something else, but historically, we do see some type of correction in the S&P 500 around this time, right? I mean, you can see it in 2012. Here's 2008. Well, 2008 again was a recession year. You can look at 2004, and you'll see like how the S&P kind of drops, gets a little bit of a late April rally, and then sort of drops into May, June timeframe. So I would keep an eye on that, especially with the HYG minus the VIX sort of back down to its trend line for the fourth time. At some point, these trend lines can break. And if you're not familiar with this metric, right, if we sort of zoom this thing out, you can see what this looks like kind of going back further. And actually, there's kind of a nice sort of trend line here at the top that it does tend to follow, which is kind of interesting to take a look at. But every so often, you will find it sort of these, you'll see it kind of moving up, and then it'll get a big drop down to the bottom of this range. Okay, so that is something I think that is worthwhile to watch out for. And when it does drop to the bottom of these ranges, it tends to correspond to pretty eventful moves in the S&P 500, right? So if you were to look at sort of this low when it dropped to the bottom of the range back in October 2022, it corresponded to that low. If you were to look at it over here, there was a big drop below it. That was obviously the pandemic. You can also see a big drop here by HYG minus the VIX, where it bottomed out December 2018. Very similar thing over here in February 2018 after a pretty big drop. Same thing in August of 2015 after a pretty big drop, and so on and so forth, right? 2011, 2010. So when this thing, as that thing rolls over and hits the bottom of this range here, that often does mark bottoms in the S&P 500. So again, there's no guarantee that we're heading that way now. Perhaps we just hold the trend line again, right? It's possible that we just simply hold the trend line once again, and we just continue to climb the wall of worry as we go into the summer months. And honestly, there's always a good chance that could happen. It's really difficult predicting when the market could deviate from general seasonality. The two main things that I could foresee causing deviations, well, there's three things, right? There's geopolitical events, which, no one's going to be timing that. So I don't even try. I don't even really try to time that stuff because it just seems impossible. Number two, inflation reaccelerating, which I could see becoming an issue, but I don't really think it's going to become an issue this year. I know a lot of people are calling for it to really reaccelerate and go back up much higher in a second wave. I think it's possible we get a second wave, but if we do, I would guess it wouldn't happen until maybe next year, after a Fed pivot, right? I think, as long as you're on this side of the Fed pivot, I would still think that it's just a matter of time before inflation just continues to slowly go down. I could be wrong about that if the neutral rate is above the current Fed funds rate. I don't think the neutral rate is above the current Fed funds rate. I think the Fed funds rate is above the neutral rate, and we're just sort of watching the whole process play out. So I don't really think that inflation will reaccelerate, back up to 7 or 8% this year. It could become a risk in future years if the Fed pivots too soon before they get inflation, say, durably back down to 2%. So the only other thing that really leaves is the labor market. So as long as the labor market remains strong, and by that I mean, as long as it's really printing below a 4% unemployment rate, then the market loves to keep on climbing the wall of worry. If you see a print above that, then perhaps you sort of revisit the bottom of this range on the HYG minus the VIX. But again, we're not there at the current time. I would keep an eye on this trend line though, and see if the S&P sort of revisits that same trend line. What's interesting is, we talk a lot about we mostly talk about crypto on this channel, but it is interesting how a lot of these things are very much correlated to one another, right? If you look at the S&P 500, you will find a trend line where it has tagged it, a number of times, right? 3 times. On the third attempt, we had a fake out below it. Now, if you were to look at, say, ETH, right, ETH USD, you will find a very similar trend line, right? You'll find a very similar trend line where it's been putting in higher lows, and on the third tag of the trend line, it was a fake out below it. So some of the times I think a lot of people sort of get caught up in the narratives of the different asset classes, but in reality, they're actually pretty much doing the same thing, right? It's just that crypto is a more volatile version of the S&P 500, right? So like if the S&P is going up, then oftentimes you will see, not always, but oftentimes you will see crypto outperform. But if the S&P is going down, oftentimes you'll see the S&P, or you'll see crypto underperform. What's really fascinating right now, though, is the fact that the S&P has already bounced off of its bull market support band, right? It went to its bull market support band. The last time it was at its bull market support band was in late October, after the long end of the yield curve went all the way up to around 5% or so. The NASDAQ already went below its 20-week moving average, and it's actually still below it today, even though the market's up 1.5%. But despite that, Bitcoin is still fairly well above its bull market support band, despite the fact that both the S&P 500 and the NASDAQ have already paid it a visit. And so that's kind of interesting. So if you do see, the S&P sort of fall back into its 20-week SMA in May, kind of after potentially setting a lower high late April, early May, if it falls back into it once again, kind of like it did right over here, right? It got a bounce off of it and then fell back down to it. If you see something like that play out, then it could correspond to sort of Bitcoin finally going back and testing its 20-week SMA. But again, there's no guarantee that it even sets a lower low in May or June. I'm just sort of showing that general seasonality outside of macroeconomic stuff and outside of geopolitical stuff, general seasonality by the S&P 500 does show that, look, there is oftentimes some weakness sort of going into that May timeframe, and sometimes it even goes out until June. So I would keep that kind of on the back of, sort of keep that on the radar a little bit, the idea of something like that potentially happening as we get out into May. So if the S&P sort of resolves into a lower high in late April, early May, and starts to roll over again, then you're going to be faced with this trend line once again, which again could correspond to around that 4,700 to 4,800 level. I mean, it's not even that much lower than the current prices, right? It would only be about 6% lower, which is basically the same amount that this first drop was, right? Over here, we dropped 6%, we got a rally, and then we dropped another 6%, and then we got a rally, and then we dropped another 6%, right? So we basically had 3 6% drops basically back to back to back, 1 month after another. So I think the ultimate question will be, though, and we'll have to sort of revisit this, assuming that it plays out, we'll have to revisit it in May or June, is that if we do come back to the trend line, does it hold as support or not, right? Does it actually hold as support? And again, remember, the market needs a reason to go down, not up. So oftentimes, just like it was back over here, we got a big bounce off of it. That doesn't mean you will always get a big bounce off of it. I mean, after you tag the trend line enough times, right, eventually it will break. It's just a matter of, how many times does it take to ultimately break it. And by the time you do break it, you might not go back to, where it previously was. But I would watch that level out into May and June and see if that trend line gets tested. And if it does get tested, whether we hold it or not will probably depend on how the labor market is doing by then. I know last year we saw a big jump in the labor market data kind of going in the summer. I think the June print saw the unemployment rate. It was the unemployment rate for May, but it jumped from 3.7 or it jumped from 3.4 to like 3.7 or something like that in a single month. And so that would be, if that were to come into play, then maybe it falls below it. But I would keep an eye on that trend line if we fade back into it in sort of that May timeframe. If you look at a date range on, sort of from here to here, that was about 22 weeks. And then from there to here, it was about 31 weeks. And then since leaving this area, it's already been about 25 weeks, right? So 31 weeks would actually put you the first week of June, for potentially retesting that trend line if it were to take the same amount of time as it took over here. And if it took, say, only 28 weeks, then it would put it in about mid-May, which would be somewhere between sort of this to here and then this first one to the second test. So I would continue to watch the S&P 500, overlay HYG minus the VIX also, I think, to give some type of insight into what's going on there. Remember, every time that it is tagged that trend line on that metric, so too has the S&P 500 tagged this trend line as well. It just, sometimes it bounces around for a couple of months before actually finding that trend line. So I would keep an eye on that as we get out into the sort of the May and June timeframe. What I find kind of interesting is that, some of these individual stocks are behaving very different than what they normally do. For instance, Apple in 2024 is actually basically, it's basically just gone down this year. It's it's actually almost about 15% down for the year, which if you compare that to 2020, I mean, by this point in 2020, Apple was actually doing better, which is kind of crazy to think about. In 2016, it was around this level, but not for another, several days, not out for another several days or so. And if you were to look at, say, 2012, you can see just how well Apple was doing back then. 2008 obviously was a recession year. 2004, 2000 was another recession year. And then 1996, right? So I just kind of find it interesting because some of the names are doing okay, but then some of these like juggernauts like Apple are really struggling, right? But if you were to go look at, say, Meta, if you were to look at Meta, I imagine it doesn't look nearly as bad, right? Meta's been doing better this year. You can see it's actually up quite a bit. Meta's up, what, like 36% year to date? compare that to 2016 and 2020, it's above those 2 years. But Apple is certainly struggling. And then you could look at other stocks like Nvidia, which has been sort of the one that's been leading this whole charge for the last year and a half or so. It's up about 60%, which is well above where it was in 2020 and in 2016. You can go look at 2012 as well, and 2008, and 2004, and 2000. And basically, the year that NVIDIA is tracking the closest right now, I guess, is the year 2000, where basically this is where it was at this point in the year. But back then, NVIDIA wasn't, you know, the behemoth that it is today, right? It was a much smaller company back then. In fact, Cisco was sort of what you might want to compare it to. But again, even those were very different companies, and I don't really think it's not like it's the best comparison. It is a comparison, but it's not necessarily like the fairest or the best comparison. But I mean, you can see just how some of the individual names are struggling, like Apple, whereas other ones are actually doing quite well. And so then on average, the S&P does tend to outperform a lot of people that sort of stock pick, because it can be very difficult picking sort of the few that are outperforming. If you guys remember, about a year ago, we had the Magnificent Seven, right? But a lot of those names have really fallen off recently, right? You've seen Apple fall off. You've seen, Tesla fell off a while back. It's been struggling a lot recently. It's currently up to, I guess, post-market, it's up to 153. So it's back up a little bit here. But you can see that Tesla year to date is actually down quite a bit. So some of those names have sort of fallen off from the Magnificent Seven, while it seems like fewer and fewer names are actually leading the charge. Like it used to be all 7 of them, but then as time has gone on, some of those names have started to really underperform some of the other ones, right? So Meta is still doing pretty well. Nvidia is still relatively elevated. Google, I think Google was, Google's, yeah, that one's still doing, it's been doing pretty well as well. It was obviously tracking it at one point. Google's still doing pretty okay too. But you can see like Apple has really fallen off here, and Tesla has really fallen off here. And then I guess Microsoft was maybe the other one we could sort of just check in on here. It actually got a pretty big drop last week, but it's right back down to that bull market support band, which is ultimately where it found support in late 2023. So I would see, if that just is going to hold support here over the next month or two as we get out into that general seasonality of May, where the market does kind of go into a lull and then it sort of builds out from there, assuming there's no macroeconomic forces at play that would cause it to take a detour from general seasonality. But anyways, I guess that'll wrap it up. I just wanted to provide a very brief update on the S&P 500. And of course, as always, there's no guarantee that you even go down to that trend line right now. Perhaps we just hold the bull market support band and continue to climb back up. There are examples of that, right? Like right here in October 2021, sometimes you just sort of get a pullback to the 20-week SMA, and then you just continue to climb on up. You've seen that a number of times where you sort of tag the 20-week moving average and then just kind of continue to climb, and maybe you keep retesting it, but the general direction remains up. So I would also keep that in mind as a potential outcome too. I think the biggest insight as to whether this correction is going to occur could be based on what is the long end of the yield curve continuing to do, right? Is the long end going up? And if it is, how high is it going to go up? Or if it's going down, why is it going down, right? Is it going down for the right reasons, or is it going down for the wrong reasons? So it obviously depends on quite a lot of stuff. But anyways, we'll go ahead and wrap it up there. Thank you guys for tuning in. Make sure you subscribe, and I'll see you guys next time. Bye.